don't find a way to make money while you sleep, you will work until you die. This is a famous quote from Warren Buffett, which many of you may have heard of before. There is the old way where you can trade your valuable time for a little bit of someone else's money. However, there's a new way where you can have your money work for you with your investment. And the new way is the investment making money for you. Hi, my name is Kristen Dickerson. Welcome to Streamline Capital Growth. Today, I'm excited to share with you a tried and true proven strategy where you can earn double-digit returns and provide good quality homes to good quality people. You can make income and provide an impact. I will provide this disclaimer, and I'm going to read it word for word so you're aware of what it is. This is not a legal, financial, tax, or accounting advice, but it is for educational purposes only. So please consult your CPA or local attorney to make the appropriate decisions for your situation. I am only sharing what worked for me, knowing it can help you as well. So whether you're a brand new or a seasoned investor and you desire double-digit returns, you want to maximize those tax write-offs, which real assets can bring us. We want to mitigate the risk and do our calculations ahead of time. We want to use our retirement funds as capital, which some people don't know is an option. All of this put together creates that generational wealth that we want to strive for our families and their legacy that they're leaving to their families. I know if you want these things and desire this, you are in the right place. And this framework will help you provide good quality homes to good quality people. And some things you can achieve by using this strategy to streamline your capital growth. You can get double-digit returns, leave a legacy of wisdom and your real assets of teaching your family how to manage what you actually are handing down to them. You can mitigate risk by using market trends and analysis and calculations. And we can create that generational wealth that we long for our families to even pass on to their families. And all of this, you can provide good quality homes to good quality people. If you want to achieve all of these things, you are in the right place. So here's some examples of what I have done. The first property I purchased back in 2003 for $97,000. And now we're at 21 years later, and it has gone 2.5 times the list price in value. Meanwhile, in those 21 years, I've collected rent multiplied by the rent values over those 21 years. So when you look at the profit, you not only have the rent, but you also have the $153K, which is the difference between what I bought it for and what it's worth today. The second home I bought a little higher, right? So then the rent's about $2,100. Today's value is $370. So then we look at the profit of $161,000 plus 16 years of rent. So literally they are paying my mortgage, interest, taxes, and insurance to be able to have my asset grow money and then pay down my debt. And these are prime examples of how you make your money work for you. This is the third house of my 6 doors. And I bought this just a year ago, and it's already appreciated $10,000 while I'm getting rent of about $2,400. So already it's growing in equity, but also I'm not putting my money into it. My money's working for me. This is generational wealth. You may have heard the Randy Travis quote. It's not what you take when you leave, because we don't have anything, right? We're going to be in a hearse. We can't bring a U-Haul behind it, but it's what you leave behind when you go that matters. And that is generational wealth. So regardless where you're at, whether you're not investing yet or you are investing, if you're investing in things that are not tangible and you're tired of those returns, if you're tired of paying those advisor fees that are hidden on the back end and therefore your net result is not keeping up with inflation, if you're tired of the risk of unsecured investments, and then you don't have those tax write-offs that real estate really brings to the table, we want to implement this strategy to overcome those obstacles and get you the double-digit returns you deserve. So are you someone who's currently investing in real estate? Are you struggling with those lack of deals, chasing that mailbox money? You're in the right place. And even if you're not investing in real estate currently, you don't know where to start. We want to get you that mailbox money. You're in the right place. This is how we're going to make it work for you. Sometimes we have a scarcity mindset that we can't get out of our bubble and be discomfort with our step above to get our money to work for us. And I'm going to show you a video that talks about how our upbringing may affect our scarcity mindset. Let's listen in.
Let's start with the current relationship with money. Now, we don't have time, unfortunately, to unpack all of the things that could be informing your current financial narrative, but I want to identify one thing that typically causes more problems than most with people's personal finances. This is the thing that clashes with the idea of financial freedom, and causes stress and unnecessary concern across all the major important areas of life. We may have goals of affluence, abundance, maybe even the creation of generational wealth, but the hidden killer of financial dreams is a scarcity mindset. Now, a scarcity mindset brings with it an overall survival methodology. Essentially, what it says is, there's not enough pie to go around. If these 5 people are doing well, I must be the one to suffer. Now, a scarcity mindset generally causes some fear and some anxiety, which statistics have proven, but also leads to short-term focused, hasty decisions around money. It makes it really hard to plan too far ahead or look too far out into the future, which is exactly what we need to do if we value things like wealth, legacy, community, and familial impact. The other thing about a scarcity mindset is it's subtle because it intertwines itself with your beliefs, your logic, and your habits in your subconscious mind, and it can do that regardless of your level of wealth. It doesn't allow a sense of clarity, peace, and direction to coexist with it. Now, this is a major issue because that could mean for you, the very thing that you're trying to create with money isn't capable of growing and thriving in the current environment. Now, when we're young, our brain's job is to adapt to our immediate surrounding by creating modes of operation that help us be successful, to exist, to do well in our current context. As we grow, those adaptive strategies in adulthood can become, maladaptive. If you were in a situation growing up where money was tight and there was the need to hoard, now in adulthood, it's hard to do things like invest in yourself or in external assets, which is exactly what needs to happen if we're ever going to have the opportunity to experience compounded or exponential growth. On the other hand, if you saw frivolous spending growing up, it may be hard to get that under control in your adult life and prioritize something as crucial as saving. Now, I want to give you a little bit of grace because when we're young, our conscious mind isn't fully formed. So a lot of the input on the big things of life, finances included, goes straight into what becomes logic, belief, and habit for us as we grow.
So just like you saw in that video, there's different backgrounds in our upbringings, whether we're used to having someone spend frivolously or we're having to scrape by. The scrape by needs to overcome with, investing in yourself and seeing the priority of that, of getting your double-digit returns. And then you have the scarcity ones if you're trying to create the boundary to say, I need to cut back on some things and get some discipline so I can invest to get my money working for me. So is that what you want? You want to get double-digit returns. You want to leave a legacy with wisdom. You want to mitigate the risk and provide those quality homes to quality people, making your impact on the community. This all creates the generational wealth that we've been talking about. And here's the thing. I understand where you're at. I've been there too. So there's some obstacles that I had to overcome, and I want to employ those techniques to you so you can get over your obstacles faster than I did. So we look at these obstacles, overwhelm. You don't know where to start. There's so much information out there and you don't know which one is true, which one is false, what's going to lead to a good outcome versus a bad outcome. You have a fear of the outcome. You don't know which way it's going to go. And then you have the time capacity. How much time and capacity do I have after a day of work to be able to invest in myself and the training that I need to be able to find that avenue of double-digit returns? And then not knowing where to start. I'm here to teach you how to start so we can overcome these obstacles together. I'm here to help you achieve the success and beyond of what I've already achieved as I continue to grow the business. So all of this leads to analysis paralysis, right? We have these hurdles, and I myself was here and I kept dawdling and doing a side hustle and trying to figure out which way to go forward. And then I decided I needed to find a way to hurdle those obstacles. So I invested in myself with training to get myself out of that. And now I'm here to help you get yourself on the line to streamline your capital growth. So because I've been there, I know how you feel. Paralyzed, not sure where to go, and like you kind of feel stuck and stagnant. You think about stagnant water and the algae growth. It makes it harder to get up, right? And then you're missing out on opportunities. Like you see people out on their boats for Memorial Day or 4th of July weekend, enjoying life or traveling the world. And you're like, why am I not doing that? And I'm stuck at my job and working countless hours for minimal income. And what if you want more? You want more than what you have currently. So if you don't know a safe option, generally you stay in the paralyzed, stagnant fashion. So I'm here to present to you a safe option. But what actually helps you overcome indecision? We're going to watch a video on that to say what causes indecision and how do I overcome it?
And so when you're in this mental maze of indecision, what determines how long you stay there is actually three inner voices. The thought that this decision of mine, it's just too big, I can't deal with it. Or it's just so far in the future, I don't have to deal with it. Or even it's just too hard, I don't want to, or I'm not going to. So what do you do? Some people might say, walk the dog, sleep on it, use your intuition, phone a friend. But science will point to something else, something more effective, reframing. So what is reframing? Reframing is something that you do unconsciously all the time without even thinking about it. It is a psychological technique where you change your perception of a particular situation. For example, a problem is often reframed as a challenge. A challenge could be reframed as an opportunity. In your youth, a drunken text might even have been reframed as a learning experience. There are many of these reframes that people do all the time. And the logic is pretty clear. If you turn something upside down, inside out, and look at it differently, you gain perspective. You gain a distance from the particular situation and hence an opportunity to move forward. And in exactly the same way, if you take these unconscious ideas that your dilemma is too big, it's too far, it's too hard, and you consciously make yourself feel that it's smaller, sooner, and easier, you will find a way through this maze.
So just like we saw in that video, indecision and inaction leaves you in the same place. But it's important to look at things when you have the perspective of it's too big, too far, too hard. What if the opposite could be true? And we reframe that. Actually, it's smaller, closer, easier than what I thought because I have strategies to put into place to make that outcome that I desire. So because I needed to find a way to get out of my indecision, I decided to invest in myself. And these are some places that I've invested in where I knew had the resources and the reputation of being successful in doing exactly what I wanted to do. So if I look at these real estate investor associations, I go to those from coast to coast. A lot of them are online now. So I can stay involved in those communities. I have fortune builders, right? Because I'm in their mastery program. So then I can use those tools to benefit and make my growth more efficient. And then the LA RIA, that's in California because I have a home in California. So I want to make sure I stay in close proximity with other investors in the communities that I have a tangible asset that I've invested in. I've invested a lot of time and money and resources to help myself grow, and I can use this experience to help you grow faster than I grew. So let's put these tools into practice and use these resources that we have. You may say, I have a financial manager for my portfolio, but do you know you have no control and you have excessive fees that you pay them that you don't even see? Do you know the stock market that they're trading in is volatile and dependent on Wall Street and politics? I don't want to give my money to something that's not stable. I don't want to give my money to something that is not certain or in my control of choosing what I invest in, because that takes away my stability of having that capital growth. So here's a second common objection I hear. I will do my own research after work. So I don't know about you, but after work, people are exhausted and they have the best intention to work at and have that capacity to absorb what they're studying, but it often proves to be ineffective. And then they're giving up family time, right? And that takes precedence for a lot of people. So have you ever said this objection? I'm here to turn that around and say, I've done the research, I've done the work. Let's put these tools into place so then we can help you streamline your capital growth faster than I did. So a third objection I've heard is I invest in intangible assets, so I may invest in the stock market. Well, I have a question for you. Would you drive your car on a GPS where you don't know the destination? Or do you have enough trust in whoever programmed that car to get you to your next destination? On the contrary, would you like your decisions to affect your outcome, knowing these are tried and true methods? I know that I at once invested in stock market and I was really disappointed in my returns. So I found another way. I would like to share that way with you. So then we get more stability in our investments, right? It's not short term, it's long term. We don't have those hidden excessive fees, and we do have write-offs, and we have a certain legacy. So get away from the intangible assets of having all that risk and lack of benefits, and let's get to what actually works. Maximize your tax strategy to bring in more income for you. So this is why this company was formed. This is exactly why I was in the indecision. I was in the I don't know where to put my money. And I said, let me be a solution to this problem. Let me invest in myself. I created a company to get away from the overwhelm and put stuff into an asset that actually will produce double-digit returns. So again, I'm Kristen Dickerson. This is about me. I'm in Madison, Alabama. I have 2 daughters who both know how to drywall, put up tape, paint, take down wallpaper. They know the business in and out. I also am a trailblazer. I love helping others and finding solutions to problems. So when I look at this, I think about this qualifies me to help others do the same. So as you can see in this timeline, I began investing in real estate back in 2003. Now it's 2024, right? So I've done a few things in between while I kept investing in real estate. I did military time. And then my husband was also in the military and retired after 20 years. We did fortune builders training together. I went and got my Alabama real estate license. I worked for the government doing accounting work and auditing work. And then I started my own real estate company because I thought, I'm working for my money for too long. It is time for my money to work for me. I want to help you achieve that same success. So here are some testimonials of a couple tenants that I have. So the top one is really the military family, and they came from out of state, and they talked about it being seamless of having, moving into my home there in Georgia. And so I had just finished renovating it from a previous tenant, and they were eager to get in there, so we got them in there. And then they retired from the military. So they, like everybody else who retires in the military, or almost everybody else, they go to Florida. Well, a couple years later, they return and say, hey, can I please rent your house again? We really enjoyed it there. And they came right back and were repeat tenants. Now, if that's not an impact, I don't know what it is. When you have a repeat tenant, it's a good sign. And the bottom one is people that were living in a hotel and needed a home to stay in. When you can find a win-win to offset those risks and provide a quality home to quality people, this brings my mission full circle. Because we're not only doing income and double-digit returns, we're also upkeeping the home and providing quality homes to quality people. And this is really what separates us apart from other investors and property management companies, because the people are part of the process. And the more we keep the people happy, the less turnover we have, which then also increases our return on investment. And that's what I want for you as well. So on the flip side, things that I've experienced that led me to wanting to be part of the solution of not only getting double-digit returns, but also taking care of the homes and the people, is that I witnessed through my military time and being stationed in different places that there were a lot of homes that people were stuck with that were not being upkept, whether it was the government or out in off post or base. There was not any accountability to maintain the home to a livable level. So what I want to do is say that's unacceptable, and if I can find a way, I'm going to find a solution to create a better environment for people to choose and have a quality home at a reasonable price while also giving the investor double-digit returns. So this one is a water leak and inattentive landlords, living where they shouldn't have to live. However, we don't have to leave it this way. We have the opportunity to use our capital not only to grow our double-digit returns, but we can also provide quality homes to quality people and keep them long-term. Another example of people were living in this environment that was unsafe and unhealthy. We don't have to leave it this way. We can be part of the solution. So this is how I provide the solution. I look and investigate what is wrong with the property. I get crews in there to fix it up and make it a suitable property so it can be a quality home to a quality person. And there's also a screening process, right, for the tenants to make sure I still have a quality person. The home I've invested in is quality, and I've done the investigation to see what needs to be fixed. And in the end, everybody wins. When you think about a good quality home to good quality people, there's 2 things of good quality in there. So I'm not going to buy a home that's subpar and then not fix it up and put someone in it. I'm going to buy a home. I'm going to fix it up so it's a quality home. I'm going to do the tenant vetting process to get a quality person in there, and they can provide the funds to be able to pay down that debt. Well, I have the asset appreciation. And then guess what? When we're enhancing the community, if I buy 3 homes in one community and I increase one, it increases them all, right? So I want to keep investing and repeat. Because if we consistently run our business based on these 3 values of taking care of people, taking care of homes, and enhancing the community, we will always be a reputable business in the marketplace. So just like Robert Kiyosaki said, an asset puts money into your pocket, a liability takes money out of your pocket. So when you think about what your assets and liabilities are on an asset liability sheet, you have to ask yourself, is it, am I taking money out of my pocket to sustain it, or is it giving me money? And you may be familiar with Robert Kiyosaki from his book, Rich Dad, Poor Dad, explaining the importance of knowing the difference between assets and liabilities. So we want to make sure we concentrate our efforts on income generating assets, which is the real tangible properties. I prepared a video for you to see from Robert Kiyosaki of how money makes you poor when the government keeps printing money and we keep saving, and how we're saving at a lower rate than they're printing. So let's take a listen.
I'm trying to explain to you, when they tell you get out of debt, that's stupid because the money is debt. And the only way money gets out of debt is via taxes. So all the people who work for money, if you read Rich Dad, Poor Dad, what's lesson number 1?
Rich people don't work for money.
Correct. Money is debt. I use debt as money. And everybody thinks getting in debt is bad. Well, who told you that? I think the stock market is for losers. Why would you put money in the stock market when it's manipulated? That's what I think about. So I'm always watching the manipulation going on behind the scenes. That's what my brain is focusing on all the time. And I don't pay taxes. The question is, how is it I don't pay taxes? And I can tell you. That's an important question, because most Romanians and most people in the United States cheat on their taxes because they hate taxes so much. But you don't have to cheat on taxes if you understood how money was working. And then they tell you to save money. Why would you save money when they're printing money?
Everybody's printing money now.
Why would you save money when they're printing money?
I know you don't save money. You're building businesses.
Why would you save money when they're printing money?
Because you didn't, I don't know.
Because that's what you've been told to do.
Of course.
So question that. You see, if you cannot think, I cannot help you. I questioned all that. Why would I save money when they print money? That's what happened in 1971 when President Nixon took the dollar off the gold standard. They can print as much as they like. Then they tell you, so that you go to school, you get a job, you become an employee. You pay taxes because you're working for money. Then they tell you to save money. Do you know why they tell you to save money?
I don't know.
Because the system of banking, it's nothing to do with communism or capitalism. It's the banks run the world. The rich run the world. They don't care if you're communist or capitalist. So when you save, so let's say you save $1 US or €1, 1 yen, the banking system can lend out 10. So the entire system is called the fractional reserve system. The fractional reserve system is also printing money. And then they tell you to save money. So they want you to save money so they can lend out your money 10 times. So your dollar became worthless 10 times over. And then they used to pay you 10% interest on your money. Now it's at best 1%. And they're still lending it out 10 times. So that's why you don't save money, is because your money is becoming worth less and less and less and less and less. The banks are getting richer and richer and richer. Then they tax you on that interest they pay you. That 1% interest, if they pay you that much. Japan is 0. Now, if I borrow money, guess what? Do I pay taxes on debt?
I guess no.
Why is that?
I know
This is what I'm saying, okay? Question everything.
Okay.
So when they lend out money, That's how money is created. Money is debt. They lend out them. Why is debt tax-free?
I don't know.
Because that's how money is created. And so the banks love it. They love people who borrow lots of money. So how do I get rich? I borrow money and I buy assets with it. The poor person borrows money and buys liabilities like purses, cars, houses, and they get poorer and poorer and poorer. But I use debt. I borrowed $300 million after the crash, dollars. In 2000, by 2010, I had borrowed $300 million to buy real estate. That made me rich. And the interest rates kept coming down, so that my cost of money kept coming down. And so everybody else is saying, oh, you should get out of debt. You know why? Because they don't question the hypnosis they're under. You've been hypnotized to work hard for money, to save it. The fractional reserve system prints it. And then you pay taxes after taxes. So I have all this debt and I get rich. So the question is, how do you learn to use debt to get rich? They've been hypnotized into being poor. Then you put it in the stock market, in pensions, right? So let's say I put $100 in a pension plan. When do I get that money back? You have to question what they're teaching you. So I put my money in a pension. I might not ever get it back because they could lose it. So the question I always say is, well, when do I get my money back? And the average person has been hypnotized. Go to school, get a job, work hard, save money, and invest in a pension. And you never get your money back. The whole thing was designed to keep you poor. Well, Fake, my new book, Fake, is just that. It's how I don't use any money and how I don't pay any taxes. Because it's fake money, fake teachers, fake assets, stocks, bonds, mutual funds, ETFs. I don't touch any of that garbage.
And you're an honest
but
teacher.
you've been taught to do that. That's the question. Until that is challenged, you're going to think fake is fake.
So again, your money is not going to make you wealthy. It's the investment that's going to make you wealthy. So let's talk about what fake assets are. Robert talked about the 401k and the IRA and stocks and mutual funds and pensions, which you hope you'll see, but probably they're going to do what they want with them for 20 years. And this residence he talks about is really a personal residence, right? Because it's not creating cash flow for you. So it's really a liability. What we want to do is get real estate that actually has cash flow, so it's paying you and someone else is paying off the debt. And for one example of a pension, think about Enron, those people that were near retirement, and then they planned to have the 1 million they had in their retirement in their pension fund, and that all went away. So where were they at retirement? It's another example of fake asset. In comparison, a real asset is something that puts money in your pocket. That creates the cash flow. So someone else is paying your debt and you have the cash flow of income. One example of real asset I can provide is the house that I told you about that I bought in 2003, right? 21 years of rental income of cash flow. Well, guess what? That mortgage was paid off decades ago. And guess what? The cash flow kept coming in, right? I'm responsible for upkeep. I'm responsible for the taxes and insurance. But that's true cash flow. That's a genuine example. So think of this quote from Robert Kiyosaki. He said, real estate investing, even on a very small scale, remains a tried and true means of building an individual's cash flow and wealth. So everybody starts somewhere. So we start somewhere, and how much we grow depends on choices that we make. If we want to apply these strategies with the capital you want to invest, we can get double-digit return and provide those quality homes to quality people. And it's never too late, and no dollar amount is ever too small. We can make it work, a win-win for everybody. Let me know what your goals are and let's exceed them. So just like the Chinese proverb, when's the best time to plant a tree? 20 years ago. What's the best time to buy real estate? Now. And one of those ways to mitigate your risk is to buy below market value. Because we all know you make money when you buy, not when you sell. So this in market trends and risk analysis to mitigate that risk, to ensure you're paying below market value and your profit is already calculated before the purchase is made. Now, there's 3 types of appreciation in real estate. You have the market appreciation, which is the market trends, right? Which we don't have a lot of control over. However, we do have control over forced and instant. Forced is I make renovation, I increase the value of that property. And then the instant is I've done my studies and I've made a deal to negotiate with a seller to buy the home below market value. So another solution is depreciation. So we use that to offset the income that we generate on the property. So cost segregation is basically being able to write certain items off in the household faster based on a shorter lifespan, basically like 5 to 15 years. So I think about things like fixtures or cabinets or flooring or appliances that aren't going to last the 27.5 years. If we get a cost segregation study done, we can actually depreciate those items faster as they don't last as long. So bonus depreciation is basically a way to speed up the cost segregation. And depending on the year will depend on the amount of percent of bonus depreciation we can apply. So like in 2022, it was 100%, in 23, it was 80%, in 24, it was 60%, and it keeps going down 20% each year until there's nothing left. However, this does fluctuate based on the politician in office. So we always look for that strategy to see, is it worth it or is not, based on the amount of percentage we have and based on the cost segregation study that we have done to see if it's beneficial for that particular tax year for that particular client. So if it does apply for you, you want to offset some income, we apply that strategy. And if it doesn't apply to you, then we skip that one for that year. We may apply it the next year. So another solution is making sure we know the after repair value before we make the purchase, because we need to know how much the property is going to be worth once we renovate it and what the market value is of the rental income to be able to calculate how much we can offer for the home to ensure our profit is stable and we've mitigated that risk by the proper calculations. So I also need to keep in mind, I need to compare apples to apples. So if you look at the homes on the screen, there are 2 large homes and one middle one, like smaller, sandwiched in between. Well, I can't say that smaller one's going to be worth what those larger ones are. So we need to make sure we compare apples to apples and not skew our data. And that is risk mitigation as well. And this is a good example of how you make money when you buy, not when you sell. So another solution we look at in the strategy is the return on investment. Every investor wants a return, right? Or else we're not going to loan our money out. So we look at the calculation that we use for as investors, and the after repair value times the 70% minus repairs is going to equal our max offer, which tells us we have to have our after repair value before we can make our offer. The 30% we hold back is the holding expenses and the profit to make sure those are in the calculation. So we are mitigating risk and ensuring double-digit returns before we buy the property. So here's the agenda. We want to see who is this for and what are the steps to streamline capital growth? And honestly, where do I start? Well, we're going to teach these strategies to you and be able to implement those at a very strategic level to maximize your return with proper risk mitigation. I've been where you are. I've been this person at the desk working late into the night and not being home with my family. But I transitioned to investing in real estate because this money works for me and I have more time with my family. Are you a person with capital or credit to get capital and you want to see double-digit returns and make an impact on the community? This is exactly for you. You're in the right place. Robert Kiyosaki says, not all debt is bad. And he used debt to be able to make him a millionaire. You can do the same thing. Like I said, if there's debt that puts money in your pocket, that's an asset. If there's a debt where money's coming out of your pocket, that's a liability. If you are one of those people that desires a double-digit return and take advantage of tax strategies, and you want to use tangible real estate assets to gain these advantages, then this is the exact place for you to be. Let's put these tools in place to be able to help you grow and give you more time with your family. So here's a deeper dive into our 4 R's of a proven strategy. The first one is real assets. Now we learned earlier in the video that what real assets are. They actually put money in your pocket. A return on investment is making sure we have more coming back to us than we put into it. And then we look at risk mitigation. How do we use risk mitigation to ensure our investment is stable? And then once you realize all 3 of these work, you just repeat the process and compound those double-digit returns. And in the end, we're providing good quality homes to good quality people while getting our double-digit returns and an asset paid off by somebody else. And this is based on consistency, doing things over and over again, expecting the same thing over and over again of those double-digit returns and quality impact on the community. So the framework I want to share with you within the 4 R's is ideal. So the I stands for income. You're getting new income, right? When you get a tenant in there. D is for depreciation. That's what I explained earlier and how you're writing off to offset the income. The equity, you're using other people's money to gain your equity, and over time it keeps going up with the list price while someone else is paying down your mortgage. You have depreciation that keeps going up, and then you have the leverage. If I took all my properties to the bank and said, I want to cash out, I could get all that to borrow and invest in more real estate, right? So this same process will repeat and compound the effect of the outcome. So this proves investing in real estate is ideal. And that is generational wealth. So what are some ways that money is made through real estate? We've talked a lot about that in this video. But if you look here, you have appreciation, which means the property keeps increasing in value, right? While your debt's being decreased with the payment of the tenant. The income is the cash flow coming back. So you have it from the tenant, right? So if you have the income and you have the appreciation, where do you get those and how do those sum up together? Those are all increasing asset values. Then we look at location. Where is the property located? Is it much sought after? You think about being near hospitals or schools or workplaces. I think when from the military environment, people don't want to drive a long distance to get on post or on base. So location's important. In the development of what the city is doing in the area, it's important to be ahead and be in on what the city is doing and where they're expanding the infrastructure, because you want to be able to maximize on that. As they're using their money to make the place better and expand it, that's only going to increase our property values. Then you have commercial and residential use. So commercial, you can be renting out to companies and people to use it like your doctors or dentists or different businesses. And then you have residential use where you're renting actually to individuals or families of them having a quality home to live in. So these are different ways, and there's a lot more, but these are some of the ways that we've talked about with this framework and this proven strategy to get you what you want and achieve your double-digit returns while providing good quality homes to good quality people. And in the end, creating that generational wealth for my family and those to come. As I mentioned before, we are very careful about doing risk mitigation and making sure we crunch the numbers before we buy. So it's important we know how to calculate the return on investment before we buy the property. So I'm going to go through some ways how we maximize that ROI. So ways to maximize the ROI. As we mentioned earlier, we always do our numbers and studies in market trend analysis to make sure we negotiate to buy below market value. We've talked about the three types of appreciation where there's market, forced, and instant, right? The depreciation where we're offsetting the income that we receive from those properties. And after repair value, how crucial that is to know that value before we even know what we can put down on the property as an offer. So keeping all these strategies in mind is how we're going to maximize our return on investment. So here's a quick analysis calculator of how I can look at what my net operating income would be. If I had a unit that has 4, like a quadplex, if I have a market rent at $2,000, right, and I have 100% occupancy, my expenses are only 40%, my cap rate's 6. It tells me my net operating income will be $57,600, which means I can offer $960,000. And to the right, you'll see the monthly breakdown and the annual breakdown. And these are things we look at to calculate and project looking long term to get the return on the investment and the timeline that we expect. So what we just looked at was a quick analysis of NOI, or net operating income, which is an entrance strategy. Now we're going to look at some exit strategies. Some people want to buy and sell right away. Some people want to buy and sell in 5 years, 10 years, 15, 20. Some people want to buy and hold for long term. So what I created here is a comparison. So if I bought a house for $180,000 and there's a 4.6% market rate, the list price is $223,000. I receive $88,000. I have a mortgage payments of $42,000, and I want to sell that property in 5 years. I'm going to incur holding costs and commissions. That will end up with my net profit being $73,000. So if you need your money back in 5 years, you can walk away with your $73,000. Now, if you want to take the strategy of buy and hold, same property, $180,000, rent received 5 years, 10 years, 20 years down the road. I kept the cash flow at $500 plus a month, right? So I used the 500 times 12 times 20 years. It's going to give me $120,000 of rent in 20 years. That's assuming the rent didn't increase. Now, we all know that's not going to happen. So it's a very moderate and conservative number. So it'll be much higher than that. But for these purposes, I wanted to compare, even at a low basis, explaining the profit of you'd have 120,000 plus the 360,000, because every 20 years, a property will double in value. So the 180 becomes 360. You add those together, you have the $480,000 with the asset. So you can choose if you want to hold it for 20 years or keep it and keep the cash flow coming in. Like the property that I have, it has been paid off. The cash flow keeps coming in, right? So you don't have to sell it, but if you choose that exit strategy, there's a time in life where you want to sell it. That's what you can walk away with in 20 years. So there are a lot of choices you can make. It just depends on what you want and how long you want to have your money invested and what return you want to get, right? So in this, we look at risk mitigation. What is the process to make that happen? What strategy are we going to implement? What policies are we going to follow to make sure we're in the parameters of our calculations? Because we really always want to improve and we always want success. So that makes us want to do those deal analyzers to make sure that risk is mitigated by using these control measures with the calculation to protect the profit. So now we know the importance of risk mitigation. Now look at what we do to mitigate that risk. We have to know the market trends. We have to know what's selling and not selling in the market. There are people that buy homes and over renovate them, right? And they think they're going to get a return, but actually they've over invested the property. So we have to know market trends. If we're educated on city plans, we know where the city is building and what streets they're expanding and where the growth is happening. So if we can be on the outskirts of that, we're going to maximize as that comes in, our property values will go up on their dime because they're spending the money to enhance the property. So if we look at research on comparable homes, we talked about the after repair value, right? What's the house going to sell for once it is repaired? So we want to make sure we've already calculated our expected profit in how much we use to renovate the home and how much we offer. As we know, we make money when we buy, not when we sell. So that math is really done prior to making the deal. So we also forecast areas of economic growth. When you think about companies coming into places or plants shutting down, those are very important factors because the workforce either is increasing or decreasing. They either can afford the home or not afford the home, right? So we want to make sure we're forecasting the economic growth and doing those studies of what is forecasted to come in the area that we're looking to invest in. Then knowing the median house income is really important. We want to make sure whatever property we invest in, that we have a large audience competing to get in that home, still giving us double-digit returns and giving them a quality home. But we also want to make sure that we're emphasizing the importance of how we work together to maintain that home, right? Those are the kind of people we want to attract. And there's also several entrance and exit strategies. So we talked about the NOI in terms of determining how much money do we need to make? Like, what is our expected return? Let's calculate it to that end. And then we have exit strategies. Do we want to buy and flip it and just sell it right away after I renovate it? Do I want to buy and hold for 5, 10, 15, 20 years? Or do I want to buy and hold it long term, even after 20 years? It's really up to the investor of what they're looking for. So in all these choices, you can make a choice to use your money to get double-digit returns, provide that economic impact on enhancing the community and providing a quality home for a quality tenant to live in. So now that we've gone over the 3 R's of real assets and what those are that bring money into our pocket, we've gone over the return on investment and how we calculate that before we buy. And then we also looked at risk mitigation to make sure that we're mitigating the risk to make sure our investment is a sound investment that will give us the return that we are desiring. All those 3 have proven to be true. Therefore, we're just going to repeat the process, right? Because now we're increasing capital. We have that cash flow coming in. We have the equity going up. We're creating that generational wealth. We're also building momentum as we buy real estate. We're building momentum and using that equity to buy more real estate. We're increasing opportunities to create an impact on the community, as well as providing good quality homes to good quality people while obtaining our double-digit returns. Then we're ready for the next deal, right? We take the equity out and we're going back to do some more. We all know it works. So let's just repeat the process and compound that double-digit return on your investments. So by investing using this framework, we are sharing with you how you actually are able to predict the outcome. So we've gone over the 4 R's. We have the strategy in place. We know it works. How is that going to make you feel? How does that transform your life? Because I know I've been where you are, and I know that I had to take the power to make a difference at that moment when I chose to invest in myself to make a better future for my family. Because really, in honest truth, financial freedom is one strategy away. So knowing financial freedom is only one strategy away, and we can implement these 4 Rs together. Just imagine having that passive income come directly to your bank account. I know we've talked previously about mailbox money, but let me tell you, in today's world, we do the ACH. It just goes directly into our account, right? So not only do I have the cash flow coming in, but I'm watching the debt decrease with someone else's income, right? So they're paying off my principal, interest, taxes, and insurance, and I'm still getting cash flow directly into my account. It's a win-win. I have my double-digit return, they have a quality home to live in, and we've made an impact on the community with increasing property values using the capital that we have sitting that's not growing currently in today's market. So keeping in mind the transformation that takes place with us, we also want to make sure we're making an impact on the community. So here's a testimony of another tenant that I have in California. She's been with me for 14 years and has no desire to leave, right? All I do is general maintenance on the home, provide a quality place for her to live, and she's happy, right? She does not want to leave. So they have, a common area, they can entertain people. Any maintenance thing is taken care of right away. So when we do preventative maintenance and we catch things right away, it really reduces the cost, which increases, the return on investment, but also keeps the rents at a reasonable level so that they don't want to leave. There's nothing else more attractive out there for them. So investing in people and homes and getting double-digit return is really a way to create that impact with also creating the income. So I've shared the strategy of the 4 Rs, how they work and how we can maximize double-digit returns in a consistent basis, right? So what can I do for you to help you do that? I can help coordinate distressed property deals, right? I'm going to link people like you that want to invest to motivated sellers. I can get things done. I'm a licensed real estate agent in Alabama. If you want to invest here and you're out of state, I can also do project management. So I know as an out-of-state owner, my limitation is not being there to watch the contractor do the work. If you're out of state, I can fill that gap for you and do the project management and oversight to keep the contractors accountable and provide updates to you as they populate. Property management, once you have it renovated, who's going to vet the tenants? If you need help with that, I'm here to help you. I've been doing it for over 21 years. A deal analysis, we'll make sure we do the deal analysis before we buy, because that's where we make the money, right? I can do that deal analysis for you. And if you think you don't have enough to get into a property, we can do a joint venture. Let's go in together and have combined equity. I can set up an LLC and then the cash flow money still comes. So you let me know what your goals are and call me or text me, and let's see how we can exceed those goals in a very risk mitigated way, getting that return on investment by investing in real assets. And that's how we create generational wealth. So here's how you get started. There's a link below for an application. Fill that out and submit it to me. Then we can go over and schedule a consult to see where your real estate journey is and where you want it to go. We want to make sure it's a win-win for everybody. So I appreciate you spending time with me today. I know we've gone over a lot of information. The real assets, the return on investment, the risk mitigation, then we repeat the process to compound our double-digit figures, right? So if you want to get started on this journey, click on the link below and we'll talk with you soon.